Good evening, everyone, and welcome. My name is Andrew Batshaw. I'm the Director of Client Services for Pennsylvania for Corner Property Management. On behalf of everyone at Corner Property Management, thank you for taking the time to join us tonight. Tonight's webinar is part of our ongoing board education series. Our goal is to provide practical information that helps board members make informed decisions for their communities. Over the past several months, there's been considerable discussion surrounding new Fannie Mae lending requirements, reserve funding, reserve studies, structural issues, and how these issues may affect condominium associations. There's also been significant amount of misinformation. So tonight our objective is to separate fact from fiction, explain what's changed, what has not changed, and discuss practical steps boards should consider. This webinar is educational in nature, is not intended to provide legal, engineering, or accounting advice for your specific community because every association is unique. Throughout tonight's presentation, I'm going to ask that you please submit your questions using the Q&A feature, which is found on the bottom of your screen, and we're going to answer as many of those questions as time permits at the end. We'll be able to see all the questions as they come in, and we will be answering them at the end. Now I'd like to introduce our presenters. First, we have Brian Weaver, PCAM, President of Association Reserves. Brian has spent decades helping condominium associations with reserve studies, reserve funding, and long-term capital planning. He comes from the association management side, so he understands the day-to-day operations and what goes into or what board members are dealing with. He brings practical experience from working with hundreds of communities throughout the region. We also have Steve Malenik, partner at Greenbaum Rose Smith and Davis LLP. Steve is the co-chair of the Redevelopment and Land Use Department at Greenbaum Rowe. Steve advises condominium and homeowners associations on governance, fiduciary responsibilities, reserve funding, developer transition, and legal compliance. Steve is also the immediate past president of the New Jersey chapter of CAI. And with that, I'm going to turn it over to our presenters. And thank you again for being here. And guys, thank you so much. It is all yours.
Well, thank you, Andy, and thank you to Corner for setting this up. This is obviously an important topic and one that, given the amount of attendees we have on this, and Brian and I are this is, I think, our fourth presentation that we've given. The attendance just keeps growing at each one of these, so it's obviously a hot topic. Today, we're focused on the Fannie Mae guidelines. Obviously, there's some interplay between what New Jersey did first in 2024 and then amended last year with their requirements for capital reserve studies and funding. And there's certainly some overplay, and we're going to touch on what that is. But this is not a presentation on that law. This is specifically on Fannie Mae's new guidelines. Andy, I know you're controlling the PowerPoint, so I think we're ready to get started now. Great. So Fannie Mae, Freddie Mac, they play an important role in the sale and purchase of condominium units and really any other type of real estate interest, residential real estate interest in which a mortgage is involved. Traditionally, you may be familiar with their role on FHA mortgages and associations of years past where you would get certification, and you'd go through a process every few years to get certified to be able to have your units in your community be eligible for those type of mortgages. But over the last 20 years or so, and increasingly so most recently, your conventional lenders are leaning on Fannie and Freddie's underwriting guidelines when they do their underwriting review for even conventional mortgages. And the reason for that, and we're going to get into it, is that I think the statistic, and I think we have it on one slide, is approximately 70% of all conventional mortgages end up getting sold to a Fannie or Freddie backed package. So it's important for them that the mortgages that they're about to enter into with a prospective purchaser are eligible to be sold to Fannie or Freddie. So when they do their review, what is it they're looking at? Well, they're looking at these 5 spokes on the tire on the bicycle wheel here. Obviously, they're looking at reserve funding, and that's a big part of what we're going to talk about today. But they're also looking at the physical condition of the property. How has the maintenance been handled? Are there structural issues such as water intrusion, things like that? What's the financial condition of the association apart from the reserves? They want to see the budget. They're going to want to see the balances in your accounts. Are there upcoming special assessments? Insurance. There are some changes that took place in what we're going to talk about in the most recent revision to the underwriting guidelines for Fannie Mae regarding insurance, and they're not all bad. In fact, they're somewhat helpful to associations to make them more eligible for Fannie and Freddie. And then, of course, the ownership structure and whether or not the project itself is eligible. So we can go to the next slide, Andy. So for today, what we're going to be talking about is a little bit of background, which I've already kind of done in terms of what Fannie guidelines are, what their process is, how they review the loans. And we're going to talk about, Brian is going to get into an alternative if you don't hit the benchmark that Fannie has set in terms of your reserve funding. There is a reserve study alternative, which in New Jersey, we have a law that we're going to talk about that probably will help you here. Andy, I know last time we talked, this was included Pennsylvania. Is that the same today?
Yes, sir.
Very good. All right. So even though you don't in Pennsylvania, if those of you who are with us reside or have boards there, this is still as applicable as it is in New Jersey. The only difference is we don't have the law in Pennsylvania that we do in New Jersey requiring reserve studies, but everything we're going to talk about today is still applicable. And then we're going to talk about why this is important, the practical application for boards, and why there are fiduciary impacts and implications to knowing these guidelines and making sure that your association complies with it. So we'll go to the next slide. All right. So the flow is a condominium unit goes out in the market. Offer is made, maybe subject to a mortgage financing contingency because the purchaser needs a mortgage to purchase the unit. Now, whether they're going for an FHA or they're going for a conventional loan, they're going to reach out to a lender, either through a broker or directly if they have a relationship with the bank. And that lender is going to start the underwriting process to determine whether or not it's a safe investment for them. So they are going to lean on Fannie's guidelines. As I said here before, you'll see the note there that Fannie supports approximately 70% of all conventional mortgages. So if your community, let's talk about the impact, if your community does not meet the requirements for Fannie to lend in that community, chances are borrowers are going to have a very hard time purchasing units. And that's going to have a direct impact on the value of your properties. And if you talk about property values and the impacts thereof, if you as a board member are not taking the steps to ensure the value of those properties are protected, you may have fiduciary duty issues, which is why this is so important. So what does this apply to? Well, if you look at the guidelines in the plain language, it specifically applies to condominium associations and cooperatives. There is some argument that could be made by some underwriters that no, we're going to apply this to all HOAs and townhomes. We don't read it that way, but as you're going to find out in a couple of slides, over the next couple of slides, a lot of the guidelines here are just that. It's like Pirates of the Caribbean, the first movie, right, where the rules of the piracy are. It's really just a guideline. And that's true here when it comes to the underwriters, the individuals, humans that are going to be coming to your community and assessing the value of your assets and your reserves and all of that. Because regardless of what the plain language may be, if they're going to ask for something, you're going to have to give it to them or else they're going to move on to the next mortgage. So it becomes more of a business case for an association to comply with these requirements rather than fight back and forth if you can help it. So let's go to the next slide. All right. So why were the revisions made? They were pretty significant revisions, and we're going to get into them. But essentially, they were done to strengthen two areas. One is, you see here on the slide, lender confidence. Okay, lenders want to be certain that what they're investing in is a safe investment. So whether it's the New Jersey law, whether it's these laws here, whether it's laws that are popping up all over the country in Florida and elsewhere, a lot of it can be tied back to the tragedy that happened in Surfside a few years ago, where a key component of that, not opining on the only component, but a key component was the lack of reserve funding and the inability for that association to fund the necessary repairs to the structural components of that building. And that's where a lot of this comes from. The mortgage lenders want to have some certainty that there is that fund available. On the flip side, and this is more specific on the changes that happen on the insurance side, Fannie was trying to make it easier for associations to have the necessary insurance coverage and other policies in place that are not onerously expensive, right? If you're a board member and you've been a board member for a little while, you know that the cost of insurance premiums have gone through the roof. And some of the changes that Fannie implemented are designed to lessen the burden. Now, personally, I haven't seen it too impactful on condominium associations that I represent because either their documents already had the requirements that Fannie previously required, so they're not going to have any relief here. But for those associations that do have that flexibility, the changes that were made were good. So what has not changed with respect to reserve studies? So you still operate, reserve studies operate as they always have. Okay, you're going to inventory what your common elements are. You're going to estimate what the useful remaining life are. You're going to estimate what the costs are going to be at the time of the replacement at the end of that useful life. And your reserve specialist, Brian, is going to recommend funding strategies to ensure you're compliant with the law, with Fannie guidelines, and best practices for protecting your community. That has not changed. Okay. So in March of this year, Fannie announced their revisions to their underwriting guidelines. There are two key dates of implementation. One is coming up in just a few weeks on August 3rd. That is when one of the key changes will go into effect. All of the changes, however, will be in effect on January 4th, 2027. And many associations are being encouraged. I'm encouraging them. Let's come into compliance now. Underwriters may start implementing these guidelines even earlier, so it's best to be aware of them and start taking them into account. The key change that is going to start in a couple of weeks is the removal of what's referred to as the limited review process. Okay. To date, right now, there is a process of review by Fannie and the underwriters that can skip what's called a full review. And that's called the limited review. And that's eligible when the borrower is putting down a sufficient number or a sufficient percentage of down deposit on the loan. Regardless of what that down deposit is, starting on August 3rd, there is no more limited review. All associations are going to be subject to the full review. That includes they're going to want to see the budget, the audit. They're going to want to see the reserve study. They're going to want to see how you're funding in those reserves in accordance with the reserve study. So that all goes into effect on August 3rd. On January 4th, the largest change and the biggest change that we're going to talk about today comes into effect with respect to the reserve studies, and I'm going to save that for Brian to really detail what that's about. And then finally, the review process. So you have the condominium project. That's your association, but it's really the entire 4 square corners of the boundaries of your association property. You're going to be subject to that full review starting on August 3rd, as I said. There is a limited exception you can see in that box, and you can determine whether or not your association qualifies. The likelihood is if you're on this call and corners your management company, you're probably not going to fall under this exception because it's for very small units. But you know that there is an exception for those type of projects. Otherwise, you're going to be subject to the full review. I think, Brian, you're starting with the next slide.
Thanks. Thanks, Steve. Okay, yeah, so we're going to jump into the next part of this presentation, and our goal here is to make this as simple as possible. I know there's a lot of confusion in the marketplace as to what does this mean for our community, et cetera, a lot of buzz, but I think it's very simple, and it's really 2 steps, if you will. So you look here at this particular page, and basically the first question you have to ask yourself is, are you going down path 1 or path 2? That's the very first part of this equation. So if you're currently funding more than 15% of your operating budget to reserves, you have met path 1. Okay, so in that regard, Fannie Mae, generally speaking, we're not going to speak for Fannie Mae that they will never, but Fannie Mae does not require a deep dive or look or even the reserve study as part of their review process. If you're funding less than 15%, you have to understand that you have now opened the hood, if you will, opened the door to Fannie Mae's guidelines and their review process. So they are going to want to see the reserve study. So the first thing you should look at is, are we funding more than 15% or less than 15%? Now, I'd like just to touch on real quick, there are some permitted exclusions to how you calculate this. For instance, if you have laundry income or other types of income, interest income on your reserves, that does not need to be factored into the equation. But let's keep this real simple. Look at your operating budget total, 15% or less, you're going down path 2, 15% or greater, you're going down path 1. Next slide. So real simple, you see here in this budget, your budget is 1.2 million. You're putting aside $240,000 currently to your reserves. In effect, you're funding 20% of your budget to the reserves. Fannie Mae is going to look at this and said there's no need for the reserve study. Let me just throw in one caveat. This does not mean that a borrower's lender may not still might not ask for that reserve study. Okay. Fannie Mae, you've met their guidelines. So they're not putting an onus on the lender to go ahead and require it, but the lender may still require a copy of the reserve study for their own purposes. Path 2. Next. Path 2. Here's where you're funding less than 15% to the reserves. This will trigger the reserve study alternative. Fannie Mae is going to look at it. They're not only going to look at your funding in the reserve study, they're going to look at what critical repairs are coming up, what kind of deferred maintenance is coming up. And then they're going to get into some of the funding plans, and they have a recommended funding plan, which is the big misconception in the marketplace. And I'll touch on that here in a moment. Key thing I want to say though, just understand if you are funding 10% to your reserves and it is a healthy number and you believe that that is all you need, this is not like a penalty, if you will. Just understand that you have another layer of evaluation from a lender, okay, at that particular time. Next page. So if you're funding less than 15%, what you need to know is that most reserve studies will include 3 plans in the reserve study. They're going to include a baseline funding plan, which is mandatory for those communities in the state of New Jersey. That's a requirement, must be provided. Many providers will provide a threshold funding plan, and most providers will provide the most conservative funding plan, which is the full funding plan. So if you look at your reserve study, I'm willing to bet that you're going to see either 2 or 3 funding plans in that reserve study. That becomes extremely important if you're funding less than 15% to your reserves. And I'll share with you why. I think, well, it's on this slide. It might be on the next slide as well. But what's critical is it's going to cause Fannie Mae to say that you cannot use the lowest recommended plan in the study. So if you keep this easy, you're funding less than 15%, Fannie Mae opens up the door, they look at the reserve study, they see 3 plans in the reserve study. They are going to require that you are funding at the highest recommended funding requirement presented. So if there's 3 plans presented, baseline, threshold, and full is what they're going to require that you fund to your reserves. Now, we haven't seen the ramifications of all this yet. What does that mean if you already have a reserve study? We can talk through some scenarios here at the end of this presentation, but just keep in mind, if you're funding less than 15%, be prepared, because I'll throw this out. If you're an association that you're refusing to do above 15% because you're trying to save your membership money, understand that can hurt you when Fannie Mae forces you to fund according to the full funding plan. Okay. So, and one thing I know Steve touched on this in our last presentation, you are not required to do anything. You're just affecting 70% of all residential home loans. So it's a real issue more for your buyers buying into the community. And you're going to hear about that from the homeowners. Next page. Okay, so in this particular example, you have $1 million budget, you're transferring $100,000. That means 10% is going to the reserves, just like I just said here. If your three plans in the reserve study, baseline says 100,000 in this particular year, threshold says 185, and full funding says 250, 250 becomes the required funding amount. Okay, next page. Okay, so I know this does not pertain to our Pennsylvania or possibly Delaware board members on here, but it is important to at least pay attention because it may apply to you in the future. For those in New Jersey, understand Fannie Mae and New Jersey have nothing to do with one another. Okay, Fannie Mae is looking at the reserve study and this process, this underwriting process, to protect their best interest. They're looking at the financial health of your community. If you fund less than 15%, again, they're doing a deep dive into the reserves. They're going to require that that reserve study be done at every 3 years. It's never older than 3 years. So that differs from New Jersey. New Jersey's requirement for the reserve study, which has nothing to do with lending now. This has to do with make sure that you have the proper funding for projects. New Jersey says once every 5 years. A reserve study must never be older than 5 years. Okay. So if I'm your average community, I probably would, if it was me, I probably would go ahead just to be safe and always get the reserve study updated once every 3 years. In the event that you end up funding less than 15%, at least you have the study done and you meet the Fannie Mae requirements. Next page. Okay, so in terms of an action plan, number one, first thing to do if you're here, if you don't have the copy of your reserve study, ask your manager from corner to let you know exactly how much is being transferred. Look at the reserve study. You want to make sure you're going down path one or path two. For those of you that have 12/31 budgets or anytime from now until the end of the year, frankly, when you're looking at putting your budget together, I would strongly encourage you, if you're close, just bump it above the 15%. Be safe. Why give Fannie Mae some reason to look at your reserve study and deny the project, which the trickle-down effect trickles down to the sellers in your community, to the buyer who's trying to get the loan, and trust me, you will hear from that seller at a board meeting. Next page, excuse me, next point, sorry, Andy, go back one. Keep your reserve study current. We just talked about that. And I know it's once every 5 years for New Jersey. It is good just to keep it current. There are so many moving parts in a reserve study. It's to your benefit. It's a minimal cost for you to have real numbers to plug into your budget each year. And then you see points 4, 5, and 6. Next page. Again, so a couple things that I just want to make sure that you're hearing from me and certain things that you're not hearing. We are not, as reserve study providers, saying that 15% is the recommended amount. In fact, most communities should be funding somewhere between 25 to 45%. I know that sounds staggering, but those are the numbers that we've been doing this for 40 years as a company. Well over 100,000 reserve studies, and time again, the communities that are in the best financial position are funding close to that 40%, 45% number. New Jersey and Fannie Mae are two separate entities, two separate purposes. I will tell you again, not to be alarmed. Most of you on this call are already funding more than 15%. And again, reserve studies are major part of your planning process. So just understand the benefits for you in that whole process. Next page. Okay, so we're going to go through 5 FAQs, if you will, and then Steve and I are here to answer as many other questions as you guys put forth into the chat. So next page here. Does every New Jersey condominium association now need a reserve study? The answer is yes. For those that have $25,000 of assets or more, you are required to have a reserve study. In fact, that requirement was put into place. You had to have that 2 years ago. And you'd be surprised how many communities every week we get phone calls from communities that either have chosen that they didn't want to do it or they didn't know about it. Steve, you probably want to comment since we're dealing with board members here. If you're a board member on this call and your fellow board members or somebody has made a decision to not follow, not to get a reserve study, not to get a structural integrity inspection when it's required, and not fund according to one of the plans, just walk them through some of the legal
Sure.
ramifications, if you
So,
will.
so really two different areas here. First, if you are in a New Jersey board and you are knowingly deciding that you are not going to follow the New Jersey law, meaning you're either not going to have a study within the last 5 years, or you're not going to fund to the minimum required amount, which is baseline funding, if you're not taking advantage of the 85%, threshold issue here, which none of my associations are. And you're knowingly violating that law. Okay. You are now foregoing the possibility of a defense, which is known as the business judgment rule defense, when a claim against you personally or against the association for fiduciary duty is lodged, because you are knowingly violating a law. And I've had associations, not for this law, but for other laws, that have decided they're just not going to follow it because it's going to cost them too much money and they don't want to do it. Well, I have fired those, and so has the management company, because we don't want that liability. Now, the second area, let's say you're following the New Jersey law, but that may be in contrast to, you're not following the Fannie guidelines, or you're not a New Jersey association, you're Pennsylvania, and you're not following the Fannie. Now, you're not going to be violating a law per se. As Brian said, these are not laws, these are guidelines. But the impact of not following these guidelines could be severe enough that your community members cannot sell their units. And you can be sure that you will hear from them at your meetings when they're unable to sell their units, so the value of their units drops. And therein lies the potential for a fiduciary duty violation as well.
Yep. Yep. Number 2, does every reserve study now recommend transferring 15%? The answer, again, like I just said, is no. When we create our baseline plans, though, as a company, we now really target that 15% at a minimum year 1, just to be able to comply. Here's number 3 is where there's been some confusion. Some statements were put out early on by some people who perform reserve studies, and they said that baseline funding is no longer accepted. That is not a true statement. Baseline, you could be funding baseline right now. If the baseline plan is greater than 15%, you're totally fine. Baseline has not been done away with. There's no issue with you following the baseline. The issue is if you're funding less than 15% and you have multiple funding plans, baseline will not be accepted. Okay, that's the clarity there. Number 4, most associations need to increase reserve transfers. Probably not. Most are already funding 15%. We already covered that. And should associations continue updating the reserve study if they already transfer more than 15%? The answer is yes. We've talked about all the benefits of that and requirements for that. That's it.
All right, guys, thank you so much. It seems that one of the biggest takeaways tonight is that the changes really are about planning, documentation, and making really informed financial decisions, not just meeting that arbitrary percentage of 15%. So we're going to move into some of the questions that we've received. Brian, this is a short question. Maybe you can help. And I think you said it, but what about the 5% and 10% thresholds? Those are still there with threshold funding still being allowed. But
Yeah.
if you're there, it's just going to trigger the review.
No, the
Okay.
review is triggered by the 15%. So if you're funding less than 15%, that triggers it. Now, if you're funding a threshold and you have a full funding plan in that same reserve study, Fannie Mae is going to require that you're funding according to the full funding plan, not the threshold. So that's where, step one, 15% or less. If you're less, now it's the highest recommended funding plan in the reserve study.
Which will always, if it is full funding, will always be more, likely always be more than what 15% would be. So you're better off just funding to the 15%.
Okay.
Yes. Oh, you get correct. Exactly. In almost every instance. Yes.
Yep. Next question. If the HOA is contributing 15%, it's HOA, so to reserve, but let's say it's a condo association is contributing 15% to reserve, but the overall amount of the reserve is inadequate, then does Fannie Mae still allow for there to be no reserve study review?
Yeah, they're not looking at your reserve study balance. That's not, and I don't want to speak for Fannie Mae, but that's not what was published in their guidelines. They're looking at how much you're putting to the reserves, not whether the amount in there is adequate or not, the amount in your bank account.
Got it.
Having said that, as Brian said before, if you hit your 15%, you're satisfying the guidelines, but that does not mean your underwriter is not going to still say to you, "Let me see your reserve study."
Yeah, that's
Yeah,
that's
and
correct. And the underwriter may say, whatever Fannie Mae says is irrelevant. We're not comfortable. This reserve, this association only has $50,000 in the account. We're not comfortable, and that's the underwriter's decision, having nothing to do with Fannie Mae.
got it. Thank you. And I think that's an important distinction that board members should have to keep in the back of their mind, that the underwriters may not necessarily follow these Fannie Mae regulations to the T and might take it one step beyond. So preparing for that is important. Okay. Next question. Keeping the reserve study current, what level is needed? Can a level 1 update suffice?
Well, yeah, I think what they might be asking is level 3. Level 1 is a brand new build from scratch report every time. Level 2 is you're doing a with site visit update based upon a lot of the counts and measurements from a prior level 1 study. A level 3 is a paper update, okay? And that the answer is I think it's somewhat gray right now in terms of will that suffice. It's gray at right now.
Yep. Okay.
Would you agree legally? I mean,
I do. Yeah.
yeah.
Got it. I think this is more of a New Jersey question. I think I know the answer, but I'll let you guys handle it. Do you need both a reserve study and a structural integrity study?
Well, you will only need a structural integrity study if your association meets the requirement under the structural integrity law. It's interesting on behalf of CAI, as Andy mentioned, I was president last year, but been involved as both Andy and Brian have been with CAI for many years. And when this law originally came out in 2024, we had spent all of 2023 working with the legislature on that. And it was our expectation that the structural integrity side of it was going to be the big public reaction. And to our surprise, when it came out, very few people really were animated about the structural integrity side, and it was all about the reserve side, as evidenced by the many presentations Brian and I have both given on this side of it. But it's a great question. We haven't touched on that. In New Jersey, there is a structural integrity component of that, where if your buildings are eligible because of their make, how their structural load-bearing system, what its materials are, things like that. And that's really that's an association by association analysis that needs to be performed. If you are an association that falls under that, then yes, you will need both a structural integrity analysis as well as the reserve study.
Great. Thank you. Have a question here. How does this affect single home HOAs?
It doesn't on paper, right? The guidelines that were changed do not affect HOAs. We're going to see starting next month if the underwriters take a more liberal approach to this for HOAs. But it is, as we sit here today on July 14th, it is my opinion, a lot of attorneys' opinions, I know it's Brian's, that it doesn't apply to HOAs.
I will throw this out there, and Steve, it's probably worthy of discussion. We think of condos usually as over under, but there are townhouse physical
Oh, yeah.
structured buildings that are condo entities, and it's that condo entity would require or would fall under the Fannie Mae guidelines. That's something that they would be looking at.
Correct. Yeah, it does not have to do with the physical structure. It has to do with the legal property type. And there's good reason, as somebody who forms a lot of condominiums too, there's sometimes good reasons why you would form a side by side as a condo versus a townhome.
All right. And then I'm just going to throw this out here because it's in the chat. What about co-ops?
Co-ops are subject to it.
Yep. All right. Uh, Question, should all reserve studies at this point just use a 15% as a minimum to support the new requirements?
Whoever asked that question, that's a good takeaway from the presentation. That's what I would do. I mean, why even go below the 15%? First of all, 15% is generally so low to begin with, but absolutely target 15%. You're doing a disservice by funding less, unless you are a massive community and 10% is more than enough. But I would not do it.
We had this question in a previous webinar, but is the 15% minimum of yearly operating expenses? I know you guys had said there's some carve outs there with income as well.
It's the maintenance fees less if you have special assessment income, if you have laundry income, incidental income, interest income from the reserves, all that can be carved out. So I didn't want to get too deep in that because if someone's asking that question, you're on the verge of, 15%. I would just go over the 15, go over that number, included everything just to be safe.
This one's probably for you, Steve. What are fee simple townhomes?
That's your traditional HOA, right? You have a condominium interest is where you own the sheetrock inn. It's a cube of an imaginary cube of space. A fee simple townhome is you own a townhome. You own the land. You may be attached to the townhome next to you, so you may have a party wall that you share, but you will own the land, but you are subject to a declaration. You are subject to rules and regulations of an HOA, even though you own the property. Whereas in a condominium, all the land you see are common elements generally.
All right, here's a good one. How are lenders required to consistently apply the new laws for each loan? And what recourse does the HOA have if a lender miscalculates and denies a loan?
Can't speak for all lenders. I mean, every lender is going to have their own criteria. Steve can touch on what happens if they miscalculate and the process of going back and forth with the lender. Steve, you want to touch on that?
If it is a one-off, meaning, the association is not having difficulty with lenders and their members being able to sell and their purchasers being able to borrow loans, but one underwriter has an issue with it, it's really not an HOA issue at that point. It's an issue for that borrower to take up with that lender or to find another lender. If all underwriters across the board are interpreting the guidelines differently than how they are written, and that's causing a problem for the association, then they should talk to their attorney about that.
This one seems like this association is having difficulty on the insurance side. Looks like they're in surplus lines. So can you elaborate on the insurance requirements for Fannie Mae?
Well, the changes that went into effect, there's for insurance, are not major for most of our associations, but they were designed, as I said before, to add some flexibility to become eligible with policies that have become prohibitively expensive. And the big thing is the roof. Fannie has always required that the insurance policy for the roofs be full replacement cost. Now they would accept actual cash value, which the difference between those two can sometimes be significant in terms of what the premiums are. And then the other main change is the deductible cap. Um, the property or the community-wide uh, property insurance deductible cap has been increased under Fannie to $50,000. I know there are many associations, especially high rises, some of which I represent, that are now going over $50,000, and that's something I'm talking to them about. And then also an individual HO6 policy is now has deductibles risen to 2,500 or 5% of the coverage amount, whichever is greater. So those were the changes that went into effect.
Got it. Um, has Freddie Mac adopted the same changes in their guidelines as did Fannie Mae?
Yes, they're consistent.
Okay. Um, Trying to see where else. I was informed from the company doing the reserve study that a level one is not a full new study. It's an update. It was included. Doesn't seem like a question. So I'll send that one to you, Brian, separately. Um, Trying to see what we got here. I think that's here we go. If we're funding more than 15% of owners not paying their HOA dues, is there a certain percentage of that bad debt that is dangerous for us?
Well,
If we are funding more than 15%, can you read? Oh, here it is. I'll read it.
Yeah.
If you're funding more than 50% and have owners not paying their HOA dues, is there a certain percentage of that bad debt that is dangerous for us? Still not sure I understand the question. I think what you're trying to say is if you budget to have 15% or more of your expenses for the year serve as a contribution, but then the you have so many owners who are not paying that you don't have the actual cash to contribute that. Is that a problem? Yeah, because Fannie is going to look at obviously your budget, but they're also going to look at your accounts and confirm that you're actually contributing what you estimated.
Okay. I'm going to ask you guys a question, and I think I'm going to wrap it up. So you both work with countless associations. What, in your opinions, is the biggest misconception that you're both hearing from boards regarding these new guidelines?
Regarding the guidelines, I think there is just, at least initially, the biggest misconception is for New Jersey. So my Pennsylvania folks, breathe easy. The interplay with the New Jersey law and whether this trumped or whether it did away with that, or what it ultimately meant for what many associations just did over the last 2 years. And if they were following the law, some associations were hit pretty hard with the necessary increases. And it was a very tough couple of years for them politically and financially to do that, and then to get hit with new guidelines that they didn't understand were actually not changing the law. It was causing quite a confusion. But now I think most people are starting to understand, as we went through it today, that this is something separate. And if you fund 15%, which if you have a reserve study and you're following those New Jersey requirements, you're going to likely have already been hitting the 15%. So it shouldn't have too much of an impact.
for me, Andy, the misconception came as a result of a post that went out again by a competitor early on, and they said that baseline was done away with, and that was just inaccurate information. It was not done away with, so that caused a lot of confusion. If I could just for a moment just share again, these are all board members and most board members on this call. I just want to encourage you guys. I've been doing this for 20 years. I've stood in board meetings where I've seen tables flipped, police called in, near fist fights, and it always has to do, always, it's not about a barking dog usually. It has to do with major special assessments. I don't have the money, et cetera, et cetera. And I get it. I get it when you're surprised by, hey, we need 30 grand in 2 years or a year or 6 months. These laws, I know they're painful, but the play out as this unfolds, if you're doing what you're supposed to, it's painful now, but there'd be nothing like waking up and knowing you have to do your roof project and you have the money and you're just picking out what color shingles. And the people coming to the meeting are saying, I want brown, I want gray. It's not, I don't have the money. And so I just want to encourage you, there's a lot of heavy lifting here the last couple of years. Stay the course, because if you're doing it and you're doing it right, you're gonna have the money when those projects come due.
I think that's awesome, Brian. And actually, I'm going to give a shout out to Corner because I had an experience just last week with a site that's managed by Corner that I've never had before. We had a meeting with over 100 attendees to talk about a new roof project that's going to cost $4 million, by far the largest investment this community has ever had. But they have the money. Not a cent is being asked for in a special assessment or loan because they were smart and they reserved the way they should have before this law or these guidelines even went into effect. 100 people showed up to applaud and congratulate the board for their well managed finances. I've never seen anything like that. So if you follow these guidelines, that could be you in 20 years, 5 years even.
Yeah, Brian, that's great advice. And I think more people need to be saying that. So thank you so much. So with that, thank you both on behalf of Corner Management. I want to thank Brian and Steve for being with us tonight, and thank everyone who attended, who joined us. Yes, this webinar was recorded. We will be posting it to our website. We will send out an email to everyone on here to let you know when it is up and available with a link as well. One of our Corner Property Management's core beliefs is that an educated board makes better decisions. And that's why we invest in educational programs like this. Regardless of who currently manages your community, our objective is to help board members understand complex issues before they become expensive problems. So we hope that this webinar has provided useful information that will help you and your boards make informed decisions. Brian and Steve, thank you so much for sharing your expertise. Everyone, thank you for being here. We wish you a great evening, a great rest of the week. Enjoy the rest of your summer. Stay cool, and keep an eye out for future webinars. So thank you so much, everybody, for joining us. We hope that you have a great night. Thank you.